All right. How's everybody doing? Happy Thursday. We've got a couple minutes before we're going to get started. We have about 2 minutes. And so, first name, you should be able to see the chat window. If you go into the chat window, drop your name, maybe your title, where you're from, coming from us today. We'd love to see where everybody is located and start to get some of that rolling. We are here for Cover Your SaaS. We're going to start in about 2 more minutes. We'll give it a little bit room to breathe and try and get everything rolling for everybody. What's up, Jana? Toronto, Sanjay. Awesome. San Francisco. Jay and I are both in rainy Charleston. It is like absolutely torrential downpour. They told us today that like we could lose power, so this is like a perfect day to do a webinar. Awesome. What's up, Dylan? Good to see you, man. Divya, Ted, Jen. Awesome. It's super cool.
Cleveland.
I wonder if everybody else is from Georgia. Hey, Hal, you're in Georgia. You're probably seeing the rain that we have. We're going to give it 1 more minute and we'll kick things off. But excited today to talk to you all about some of the financial aspects of the business. That's my dog. I have treats. We are releasing the treats. Super excited today to talk about the financials of the SaaS business and trying to level up some of what you all are working on. These dogs are, if anybody knows this, I've got treats under my desk in my hand right now, trying to drop them slowly to the dog. If anybody knows that trick or has done that before. What's up, John from Scotland? That's awesome.
Yeah, we got an international crowd here in Germany.
We do, yeah.
Stephanie, Nashville, my favorite city on earth.
Right, we're at 11:01. We like to be prompt, so we're gonna get started. Welcome to Cover Your SaaS. This is our first workshop of many that we're going to do. Today we're going to be covering unit economics, but really the goal of Cover Your SaaS is to help financial literacy for SaaS leaders. How can we really help you all level up? So Growth Curve is our newsletter and media business that we started. We're here to help serve SaaS leaders. Turnkey is the sponsor for today. Turnkey is a retention automation platform for high volume subscription and SaaS businesses. The platform offers customer-friendly self-serve cancellation flows and advanced fail-paid recovery solutions. If you go to turnkey.co, you can check them out. But on average, their customers reduce churn by about 20 to 40%. You can see some of the logos right there on our homepage. And really appreciate for them to help us sponsor today's webinar. Let's move forward one. For those of you probably know us already, but you've got myself, Jeff Brunsbach. I'm the co-founder of Growth Curve, and what we're doing. Been a SaaS leader around marketing and customer success for a long time. We had Customer Imperative, which was a consulting business. We did Pay to Retain, which was a community. So just been around kind of things. Jay is going to be your speaker and host today. Jay recently joined Turnkey as their COO, and so he'll talk a little bit more about that. Before we jump in, I did want to give a plug for our course. We built Cover Your SaaS as a 3-section course. It's about the fundamental language of business, the understanding of subscription businesses, and then how do you make an impact. We've had over 100 people already buy this course in the first couple of weeks. We sold hundreds of licenses to businesses for their leaders and try and put them through the program as well. Something that we're really proud of, put a lot of time and energy into. So for you all coming to this webinar today, we wanted to make sure give you a little incentive. If you scan the QR code, if you type in the URL there is a little 10% off if you all would like to purchase the course. If you want to buy 5 more licenses, you want to buy it for your team, we are in that motion right now. So email me at jeff@growthcurve.io. But by and large, the biggest thing that we keep hearing from leaders right now is that it's just information that's extremely helpful for them in their careers. How do they make decisions? How do they think about the business in the right ways? And how do they really start having conversations at an executive level? David Clark, who's a chief customer officer, had one of our best testimonials so far. You know, he said he's been in SaaS for 20 plus years, been an executive leader. And this course was still extremely refreshing for him to bring some of these concepts back up to the surface. So that's the plug that we'll give you real quick. I'm going to turn it over to Jay, and I'm going to let him talk us through unit economics today.
Awesome. Well, it's wonderful to see so many of you on the live stream here already. We're excited to be doing this, and we're going to do this each month. And Jeff will mention a little bit more about our next one of these that we're going to do in May. But this is a project that started really 20 years ago. I remember sitting in a meeting when I first became a manager of a large professional services team at my first software company. And we would have these weekly reviews of metrics and financial reports and data. And I had managers on one side of me and executives. I had my peers on the other side of me. And we were reviewing things that I hadn't seen yet in a business context outside of going to business school. And so I felt like an imposter a lot of times. And as we got to the end of 2023 and got toward 2024, it's clear that the world has changed. We'll talk a little bit more about that in a minute, especially for SaaS companies. But we set out to build some ways for customer success leaders to think about how they could make a bigger impact on the financial state of their companies. And as we were building that content, it was clear that this was going to be way more impactful than just for customer success people. Of course, it applies to them, but it also applies to marketing, to product, to sales. Anybody that is a leader inside of a SaaS company, if you're more aware of how your work ties to the financial outcomes of the business, you're going to be able to be more impactful, and you're going to grow your career faster. So that's what this is all about. And we're doing this because we are genuinely interested in this and excited to share. I'm excited to share, some of the things that I picked up. I certainly don't know everything, but I picked up a lot over 20 some years, and excited to sort of share those some of those lessons with you. So what we're going to cover today, we're going to talk about the SaaS P&L. What is it? How does it work? We're going to talk about unit economics, which is how you figure out if a business is going to be profitable in the future or not. And then we're going to talk about how you can make an impact on your business. So I'd encourage you, we're going to be keeping an eye on the chat as we go along here. Jeff just put a note in there. If you have questions, we're going to do some live Q&A at the end. Actually, not live. We'll have Jeff read the questions out at the end, but throw them in there and we'll do it. Just, finance could be a boring topic, but we're not going to let it be boring because we're going to make an impact. And I'm really excited about this and the ability to do that. So let's jump right in. I'll start by sharing a quote from my friend and author Dave Jackson. You may know him if you're on LinkedIn at all. He wrote a book called The Customer-Led Growth, and one of the statements he made in this book is really good. It says the purpose of a B2B SaaS company is to deliver products that convert measurable results for our customers into profitable revenue for the company. And if you've followed me for any amount of time on LinkedIn or the things that we have to talk about, you've probably heard me say that SaaS companies are like customer success engines, right? And that really is true. No matter what department you sit in, we're trying to make successful customers because we have to make our customers successful for this whole thing to work. And we're going to dig into why that's true. The other thing that's now true that, really hasn't been true over the past 10 or 15 years is that profitability now matters. Having a path to profitability now matters. Being default alive as a company now matters. If you don't know what that is, you can go read our newsletter from last week and there's a blurb in there about it. But it's really important that all of us as operators, no matter what seat we sit in, marketing, product, sales, or anything else, have an eye on how our work, how the cost we bring into the business actually supports the business and drives it forward. We are in we used to talk about new normal during the pandemic, but we're really in the new normal now, which is the post-zero interest rate period. And many people say that this is the profitable, efficient growth period. And I'll give Sam Jacobs the credit for that moniker there. So that's what we're going to talk about. Let's go figure out how we can make an impact on our companies and grow our careers at the same time. So to set all this up, I'm going to tell you about a fictitious company that we've launched called PeopleZen. PeopleZen is a SaaS company, about $50 million in recurring revenue. We're in the HR tech space. You can see here we do digital marketing, onboarding, and learning management, although we're going to have to get a new branding agency because the one we're using today does not know how to spell. Thanks, ChatGPT. So PeopleZen is growing at about 18% year over year. We have about an 85% gross retention rate. That's not bad. Industry standard, we'd like to see that closer to about 90 to 95%. We're going to work our way toward that. The good news is we have 103% net revenue retention rate, which means we're growing our existing customers even faster than we're losing revenue. And then we have 8% what we call EBITDA margins. And so we're going to talk a little bit about what EBITDA means here in a minute. But we have a couple of goals, just two simple goals, really simple, right? For 2024. Number one is we want to grow the ARR of People's Inn by about 20%. And number two is we want to grow our EBITDA margins by about 2% from 8 to 10%. So we're trying to do two things that are sort of opposing in nature. We're going to try to grow the business while we're also making it more efficient. And a lot of companies are in this situation today. Okay, that's the reason we're sort of framing up this case study the way that we are, because your business is probably trying to do the exact same thing right now. So that's we'll come back to People's Inn in just a few minutes and talk about some of the actions that we're going to take to try to improve this business. But before we do that, I want to introduce you to a couple of things on the financial side. So in any business, pretty much any business on the planet, there are about three financial statements that you just really can't get around. The income statement, also known as the profit and loss statement, or the P&L, you may hear it called, the cash flow statement, and the balance sheet. So the income statement, that's what we're going to focus on today. It really tells us what the income of the business was from a revenue standpoint, and what the expenses were and what our profits were during a given point in time. So companies typically publish these on a monthly, quarterly, annual basis. Cash flow statement tells us all about the cash that's coming into the business and the cash that's flowing out. That could be from customers coming in, it could be to suppliers, to salaries going out the door. But as you all know, if a company runs out of cash, that's when it goes out of business. Okay, so to stay solvent, a company has to keep a close eye on their cash flow. Balance sheet is basically like your bank statement that you get at the end of each month to tell you where your financial position is. So the way we talk about this from a corporate perspective is, what does the company own and what does the company owe at the snapshot in time? Now, we're not going to talk about the cash flow statement or the balance sheet anymore in this webinar. We're only going to focus on the income statement. Jeff pointed out the course that we've launched just a few minutes ago. It goes into gory detail on all this stuff there if you want a little bit more detail on how all that stuff works and relates to your day-to-day. So, but today we're going to focus on the income statement. So let's dive in a little bit deeper. So what is an income statement? Like I said, it shows the company's revenues, expenses, and profitability for a period. It's governed by a very simple formula. Revenue minus expenses equals profit. Okay. Now, interestingly, a lot of SaaS companies run a negative profit, and that's because a lot of SaaS companies are growing, and we'll see why that is in just a few minutes. But that is the governing principle of an income statement. Now, income statements and other financial reports like the ones I just mentioned are governed by accounting standards. There's something called the Financial Accounting Standards Board in the United States, and there's one internationally called the International Accounting Standards Board. They make all these rules, they define this, but they do it very, very broadly for the entire world of companies. So first, we'll look at what the income statement is and the pieces of it. Then we're going to look at a SaaS income statement. So as you might expect, of course, we have revenue, all of our income. Below revenue, then we start getting into the expenses for a period. And again, if you look at this P&L, we're talking about Q1. So Q1 just wrapped up. Okay, so we'll assume that this is for Q1 2024. The first area of expenses that you'll find on an income statement is cost of goods sold. We think of these as variable costs, right? So if I sell widgets, for example, I sell the widget to my customer for $1 and it costs me 50 cents to make the widget. My cost of goods sold there is 50 cents. Okay. So that is the incremental expense that we have every time we sell a new customer. We'll talk more about that in a SaaS context in just a moment. Operating expenses are the fixed costs of the business. That's the selling costs, the product development costs, the back office costs for our HR, our finance team. It could be our HRIS system. It could be our finance and accounting system. It could be leases that we have on our office. And then there are other expenses below the operating expenses, which are things like interest and taxes, things that are sort of variable depending on where you do business, how you funded the business. Now, you hear this term thrown around all the time, the bottom line. the bottom line is the bottom line because it's actually the bottom line of the income statement from a GAAP perspective, which is net income. And that's what do we have left over after we take all the expenses out of the income that we've made as a business. Okay. So this is a standard P&L. Now let's look at what a P&L looks like for a SaaS company, because now we're going to get into some terminology that you probably will recognize from your work in a SaaS company. So first, let's focus on the revenue line, and you can see we sort of how it maps to the P&L here. So in a software company, often we have multiple types of revenue. We might have subscription revenue. That subscription revenue might be broken down by monthly subscribers or annual subscribers. Okay. It might be usage-based. So think about companies like Snowflake and Amazon Web Services and Microsoft Azure. These are usage-based platforms. So you might break the usage-based line item out. And then there are things like one-time revenue or professional services revenue that could even be recurring that might show up separately in the revenue line of an income statement. Now, why is that? Because not all revenue is made equally. In a recurring revenue business, what we are trying to do is build that recurring revenue annuity. And when we do that, it's going to increase the value of our company faster than selling services per se, because people value recurring revenue more than they value one-time revenue. That's okay. We're still gonna have both, and we still need both. So that's the revenue line item, and you'll typically see that. By the way, if you have questions about this, everybody's P&L is slightly different. Everybody's SaaS P&L. So I'd encourage you to go talk to your CFO or your VP of finance or the controller of your organization. Just go get curious. Ask them how they lay the P&L out. Ask them about some of the things we're talking about here and learn how this works exactly in your business and how they think about it. It'll be really informative for you if you do that. Okay, then we're going to jump into cost of goods sold. So in a SaaS company, what are the cost of goods sold? We're not making widgets, right? We're making software. So what are the delivery costs? That's the way I think about this, the variable cost of delivery that we incur every time we sell a new customer. Well, we have to do a few things. We have to host our product, right? And that usually sits on a cloud platform like AWS or Azure. We might resell other people's products. As companies get more mature, that's very common. So if I resell somebody else's product for $100 and then I have to pay them $50 for that sale, then that is a third-party cost of goods sold. You can see there's a line item here for that, okay? Now, one of the bigger chunks that you're going to find in the cost of goods sold line item is the people cost related to delivery. And in a SaaS company, that typically encompasses three groups. Number one is going to be support. Number two is going to be professional services. And number three is going to be customer success. I have a little star by that. I'll tell you why in a moment. But think about all the training resources, the delivery resources, the services resources. These are hard costs to the business, but the more customers you have, the more we have to staff those teams up to deliver for those customers. So these are delivery costs, okay? Very important. We're going to talk more about that in just a few minutes. Then we have operating expenses. So operating expenses are, again, are fixed expenses in a SaaS company. Think about all of the expenses or all the costs related to how we build and sell our products, okay? So think about the sales and marketing. We're gonna hit on that really hard in just a moment. The product development team, the designers, the engineers, the product managers all fit in this second bucket, product development. And then general administrative, and that you may hear that called G&A. And what that is your HR, your IT, your finance team, the systems that support the business operations overall, they're going to sit in that bucket. Okay. Now, very importantly, if you look at closely at this P&L, you're going to see that there below each one of these categories, there is a margin calculation. And what margin simply means is a percentage of something else, right? And so what we're saying is after the cost of goods sold are subtracted from the revenue, we have something called gross profit left over. And the gross profit divided by the revenue is going to tell us what the gross margin was. So in this case, on my fictitious P&L, this is a 77.5% gross margin business. That's pretty good. It's right within the range. We expect most SaaS companies to be in the 60 to 85% gross margin range. Okay, so this is right in the middle of that. We like that. Then you have operating margin, and that is after we go ahead and subtract out the costs of selling, building the product, and running the business, that's what's left over here. So if you hear the word margin, gross margin, operating margin, you'll sort of know where those get derived in the P&L. Of course, we have a net income line after we take all the expenses out, but something else that's not depicted on here that I'll walk you through real quickly is something called EBITDA. And essentially what EBITDA stands for is earnings before interest, taxes, depreciation, and amortization. What the heck does that mean? That's it's really it's a pure business performance metric for profitability. Okay. And we use that in SaaS companies so that we can compare them apples to apples. We take out local taxes because running a business in different areas has different tax implications. The way the business is financed is going to be different from company to company. What EBITDA does is gives us a pure apples to apples way of looking at the operations of the business, how we're making money from our customers, and the expenses associated with delivering our products and services to our customers. We'll talk a little bit more about EBITDA in just a minute. So what you've got here, this is a simple cheat sheet that you can take a screenshot of it now if you'd like to. We're also going to send this to you in an email afterward. But I find, especially if you're newer to this stuff, that it's helpful to have like a reference guide of some of these terms so that you can sort of remember like, okay, what goes into which bucket? This may be able to help you with that. So that is the income statement. You are educated now on that. And this is, there's a lot of complexity that you can get into here. By the way, we're also, in addition to that screenshot, we're going to send you a lot of other resources that you can utilize to go deeper on this stuff if you want to. But the cool thing is you can take what you just learned from the income statement. You can go to Google Finance. You can go to Yahoo Finance. You can go to Barron's and look at the public company filings that happen every quarter and see these metrics and this data on publicly published, so you can start to understand how some of the largest software companies, Snowflake, Salesforce, HubSpot, how they calculate some of these metrics, and it's really interesting to look at. Okay, so now we're going to turn our attention to unit economics, and to set this up, I'm going to tell you about a little company called. Has anybody ever heard of First Citywide Change Bank? If you haven't, you should check them out because they're the best bank in the world at making change. And what that means is you can take them a $5 bill and they're going to give you 4 ones and 4 quarters. If you take them a $20 bill, they can give you 3 fives, 3 ones, and 20 dimes. They can do any combination of change you would like. Okay. So just teeing up, this is how they do business. And you can tell me.
All the time our customers ask us, how do you make money doing this? The answer is simple: volume. That's what we do.
Obviously a joke, right? You may have heard the saying, we lose money on every deal, but we're going to make it up in volume. That is not how it works. So it's really important for a business to be able to tell on a customer by customer basis, are we making money? And in SaaS, we have a particular challenge of figuring that out because we have different parts of the cost structure for a customer are spread all over that P&L that we just looked at. So if we're going to figure out if we're actually making money, we have to get into unit economics. So the challenge with a SaaS company, pretty much any SaaS company, is that the cost of acquisition of acquiring a customer is all incurred up front, and we don't make the money back on that sale. We make it over very long periods of time. This image right here is actually 10 or 15 years old. And if you haven't read David Skoke's stuff on forentrepreneurs.com, it's all like 10 or 15 years old, but it's all 100% relevant still today in terms of how a SaaS or a subscription business works. I'd encourage you to check that out. But in this example, what we're showing is that we spent $6,000 to acquire a customer. Okay, so we spent $6,000 in hard cash to acquire a customer. And then what's happening is we're earning $500 a month. That's a $6,000 customer, right? We're earning $500 a month every month we serve that customer. So you can see how the cost is all front loaded. And this is the way that every SaaS business works. This is the fundamental challenge with SaaS. And it's why we raise so much money to get SaaS companies off the ground, because it's expensive to go to market. Now, if you look at that over time, you can see how as we start collecting that revenue for that customer, we eventually get to a break-even point. Okay, in this example, it looks like we're breaking even around, around 13 or 14 months. Now, we just published a newsletter yesterday morning. If you go read it, you can sort of find this blurb that in the public markets, the median break-even point is at 38 months right now. 38 months. That's 3 years until a new customer that we sell today becomes profitable. So what does that mean? That means everybody's job just got harder. The sales team, the marketing team, they have to sell deals that are better, that find those ideal fit clients that are going to stay for a long time. If you're in the post-sale world, you're going to have to work harder to keep that customer longer. Not just the first or the second or the third year renewal. You've got to retain them for 4, 5, 6, 7 years. Okay, if your costs are that high. Now, not everybody's costs are that high, but this is a really critical challenge for us, especially right now. And there's a couple of ways to solve it, which we'll talk about as we get into the unit economics here. But I want to impress on you just how important it is, how important retention is to a subscription business because of this problem, because of the front-loaded nature of the cost of the business. Okay, so let's jump into how we actually calculate unit economics. I really like unit economics. This is not a perfect calculation, by the way. If you Google this, there are a bunch of ways you can pick this apart. If you're a really early stage company, it might not apply so well. If you're a really, really late stage company, it's got other problems. But generally speaking, this is a good way to look at how profitable your business might be in the future as you continue to sell new customers. We call it LTV to CAC ratio. And I'll walk through how it's calculated. So first, on the left-hand side, we have lifetime value. This is customer lifetime value. So how much is each customer on average going to be worth to your business? And here's how we calculate that. We take the gross profit. Remember, we looked at gross profit on the P&L. That is the revenue minus the delivery costs. So we take the gross profit of all the customers that come in, and we divide that by the churn rate. And we do that because that helps us understand exactly how long that customer will be a customer by looking at the churn rate on average, and then what the dollar value of that is going to be. So lifetime value, this is a very simple calculation. There are more complex calculations for lifetime value than this, but we're going to keep it simple as we get started here. Lifetime value is the first part of the equation. On the other side of the equation, you have the expenses that it took to acquire that customer. So marketing, think about the paid ads that you do on Google. Think about the events that your team attends. Think about the marketing team salaries, the sales team salaries, the commissions that we pay on the deals, all the tools that we use to sell our customers. That all goes into something we call CAC, or customer acquisition cost. And you can see from the way this scale works, we need lifetime value to be much bigger, much heavier than CAC, right? On average, a good ratio that you would want to look for in any SaaS business or any recurring revenue business for that matter is you want your lifetime value to be about 4 to 6 times your CAC. Okay, so that's what we're looking for. Even if you're at 3, that's not a bad place to be to start. So these are the fundamental components of unit economics and how it all fits together. I really like this because it takes components from all over the business, right? The way we deliver to customers, the way we design and build the product, the churn rate as a result of that, how well we've targeted the customers, the cost that it took to market and drive awareness and sell to them. And it puts it all together in a way that shows how everything is interconnected. In a SaaS company, everything is interconnected. Recurring revenue businesses are extremely sensitive. You make a change in sales and marketing, you're going to feel it on the customer success side of things. If you make a change to how you support your customers, you're going to feel it in another part of the business. If you make changes to your product, you're going to feel it elsewhere. So really, really important to pay attention to. All right. So how can we make an impact on this? There's really 4 ways. Okay. I hope you all can hear me because I am getting an internet unstable message right now. Can somebody give me a message if you can still hear me? Okay, good. Thank you, everybody. Awesome. So there are 4 ways that we can impact unit economics. Okay, these are sort of high level and simple. But number 1 is we can increase the average revenue that our customers pay us. We might do that with increased prices. We might do that by selling our existing customers more or cross-selling them new products. Okay. The second way we can improve unit economics is that we can increase gross margin per customer. That means we get more revenue from them, which is good, but we have to keep our costs the same. So we want that margin rate to go up. We want to keep more of that revenue in our coffers and not spend so much to deliver those customers. That means we might make our support team more efficient, or we may implement AI to do some of our professional services work so that we are spending less. Maybe just keeping our teams flat doesn't even mean that we're going to cut people out of these teams or costs out of these teams, but in some way we're optimizing that spend so that we're not growing it linearly as we grow the customer base. The third way to improve it is, of course, to increase gross retention rate. And there's a number of ways that you can do that depending on what's going on in your business, right? And how your product is built, how you take it to market. But basically, this is elongating that customer lifetime. Remember the calculation we looked at just a minute ago, or the customer we looked at with the 1-year payback period. We got to do that for however long it takes. We got to keep these customers in the boat. And then finally, we can increase the efficiency of our go-to-market. And what that might look like, or some of the examples that I mentioned earlier, you might trade off some of that ad spend for more organic spend on your marketing efforts. You may have fewer sales reps with higher quotas. That's happening right now. There's debate on whether that's a good thing or not, but that is a reality of where our businesses are at. Okay, so these are the 4 ways that you can improve your unit economics, and we'll come back to this in our review in just a moment. All right, so now I want to turn your attention back to PeoplesIn. I'm going to take a sip of water because I'm talking so much. Let's go back to PeoplesIn. So remember, we had 2 goals for the year. Goal number 1 is to grow our ARR by 20%. And goal number 2 is to improve our EBITDA margins by 2 percentage points. Okay. So we'll start with growing our ARR. This is our plan. I'm the COO for PeoplesIn, and I've been working with my teams. Here's what we've come up with. So first off, of course, we're going to go hit our planned bookings number. That's just a given. We got to go do that. That's for new bookings or new sales. We're going to go drive that far. But then we'll come back to a couple of the items we saw on the last page, which are we're going to increase our average revenue per customer. How are we going to do that? Well, we're going to go roll out some price increases to targeted segments of our customers. We've been building this product now for 5 years. We haven't really adjusted our pricing for 3 years. And so we're going to go to the customers that are renewing this year, and we're going to offer them some incentives, a better product, more features, more capabilities, and we're going to bump their prices up, put them on a new pricing plan. Okay, so that's number 1. Back when I was at a large publicly traded software company for 9 years, and we had this employee lead program. Anybody in the organization could submit a lead and get paid on it, whether it was new business or an upsell, whether it was a support team, it could be the marketing team, it could be the professional services or customer success teams. So we're going to implement an employee lead program. A lot of companies are doing this today. They're typically thought of as customer success qualified lead programs. But we want our internal teams to be attuned to what the opportunities are for expanding our existing customers. So we're going to implement that program. Then we're going to look for other ways. We're going to go targeted to our customers. We have 3 products I mentioned on applicant tracking, onboarding, and learning management. Applicant tracking, all of our customers have that today. Only 20% have our other 2 products. So we see a lot of green space in there to go and expand with those other products into our customer base. And so that's what we intend to do this year. The other thing that we're going to do is we're going to improve our gross retention rate, because guess what? That actually helps drive our ARR growth year over year. If I'm retaining 87% of my recurring revenue versus 85%, well, I've already got a 2-point head start on that growth. And by the way, if I'm churning 15% of my customer revenue on an annual basis, that means I have to go sell that 15% before I start growing, right? Now, luckily, we have a great net retention rate, which helps out there. But we always want to try to improve that. We always want to try to grow as fast as we can as a SaaS company, because that's just how we improve the value of our business. So we are going to we are going to do those things to improve our gross retention rate. We're going to focus on first year renewals. Jeff and I did a consulting engagement a few years back with a company that had a massive churn problem. We dissected it. We looked at it from all different angles. We pivoted the data. We looked at the customers. And what we found is that the majority of the churn was coming in first year customers who did not make it beyond their first renewal. And you saw the economics of that already, right? That's painful. So what did we do? We focused on a really strong onboarding program with that organization. And they implemented that and have done fantastic. We're going to do the same thing at People's End. So I'm really excited about it. We're also going to implement a renewal program that runs in parallel to all of our customer success motions so that we're having conversations early with customers about their renewal, about the price increases that will come with those renewals, and about the additional capabilities that they'll have with the product. So that is our plan for growing ARR. Now, goal number 2 is improving EBITDA. So we're going to do that in 2 ways as well. Number 1, we're going to try to improve our gross margin. So remember, I'm going to go back to the P&L for just a second. If we're going to improve our overall profitability of the business, there's 2 predominant areas where we can focus on from an operational perspective to do that. Number 1 is improving our gross margin. So reducing the cost of goods sold relative to the revenue that we bring in. The second area is in operating expenses. And so we've aligned a couple of goals to each of those. So if we're going to improve gross margin per customer, first thing we're going to do is we're going to start charging for some of our services. I work at the same company that I mentioned earlier that I worked for 9 years. We launched a new enterprise product at that business. It grew really, really quickly. It went to $70 million of ARR in just 2 years. And we had to build a huge services team and give away a lot of services to do that. And so when you do that, you actually end up spending a lot more than you intend to, and your gross margin gets compressed. So what we started doing after year 2 there is we started packaging our services. We started charging customers and holding them accountable for helping us maintain scope of those implementations. And we found a way to improve our gross margin. So that happens all the time. If you have a lot of people helping deliver, how can we make that more efficient? So that's the first thing we're going to do. We're going to start charging for services. My friend Jeff will be really excited about that. The other thing we're going to do is we're going to try to reduce our hosting costs because, we have all these customers today and we use a lot of resources in Amazon Web Services, even during slow periods where the customers aren't using the software as much. So our engineering team is looking at ways to optimize our costs there. And by the way, we might go back and try to negotiate with Amazon as well. Good luck, but we're going to try. And then finally, we're going to make our support, our professional services, and our customer success team, we're going to try to make them more efficient by implementing AI tools where we can that take some of their workload off. Not so we can cut the team. We don't want to do that because we're still planning to grow our ARR 20% this year, but try to make them more efficient so we don't have to add as many headcount as we might otherwise have had to in 2024. Okay, so those are our plans for improving gross margin. Now, what we're going to do on the operating margin side is we're going to ramp up our marketing efforts. We're going to do webinars like this. We're not going to pay so much on the Google side of things. We're not going to participate in so many expensive on-premise events. We're going to do more organic and useful community style content for our customers. We're going to hire fewer new logo reps this year, and we're actually going to increase their quotas slightly, just like I mentioned a couple slides ago. And then we're not going to cut our product development and G&A headcount, but even though we're going to grow 20% this year, we're going to try to keep that flat. And I think you will find a lot of businesses that are in the similar boat to People's End this year, SaaS businesses they're probably taking a similar strategy to this. So that's our plan. I hope you like it. We're going to report back to you in a couple of quarters and let you know how it goes. Obviously, just this is all fictitious, so don't worry. You don't have to come listen to an earnings report for People's End. All right. So I've done a lot of talking. I'm going to recap for us quickly, and we're going to try to go to some Q&A here in just a minute. So if you have questions, go ahead and throw them in the chat. And then Jeff is sort of aggregating those on the back end, and we're gonna have a chance to talk about them. So, number 1, key takeaways here. Number 1, SaaS businesses require a balance between a lot of different factors. You've just seen that, right? The unit economics calculation alone brings into scope almost every department in the company, and so that's what your CEO and your board they're constantly thinking about. Okay, there are 4 ways to impact unit economics. You can drive revenue per customer up You can improve your gross margins. You can improve your gross retention rate, meaning you keep your customers longer, improving that customer lifetime value. And then you can also make your acquisition more efficient. Just a side note on this, when your executive team is sitting in a board meeting, when they're in an offsite, these are the kind of things that they're looking at. So they may be talking about product development plans. You as an operator may be working on sales efficiency and conversion rates. In marketing, you may be focused on website traffic and webinar attendance. In customer success, you may be trying to drive satisfaction and engagement with your customers and support. You may be looking at CSAT, NPS across the business. But just keep in mind that all of those are leading indicators to this stuff for the business. You've got to do those things because it indicates the quality of your delivery for your customers and the quality of your operations. But remember, as you go through 2024, that all of those things are in service of the business, of the financial outcomes of the business. And if you, as a leader, can tie your work to these kind of items, you're going to be taken more seriously as a leader, as an executive in your company, and you're going to have more opportunity to go do what you do so well. One of my favorite people to study right now is Charlie Munger. I sort of see him popping up everywhere. He just passed away, famous investor alongside Warren Buffett. But he has a saying that being a better businessman makes you a better investor, and being a better investor makes you a better business person. I actually think if we look at ourselves in the SaaS world the same way, being financially literate, being a good business person will make you a better operator. Being a better operator who knows the details of what's going on in your business will make you a better business person. So I'd encourage you to really take this stuff to heart. If you haven't taken the full course, there's a lot of content in there that goes a lot deeper on some of these concepts and really gives you more metrics to think about and more ways to think about your part of the business. So we appreciate you coming and spending some time with us. We'll pause right here. Jeff, I'll turn it over to you and see if there are any questions.
We do have a lot of questions. So much so that I'm already going to say that we probably won't get through all of them. We will write them up and most likely send them out as a newsletter. So we'll plug that at the end, take you can sign up for that and make sure. All right, first question that I'm getting to is from Parker. Parker asks, are labor costs broken out across the different types of expenses based on what type of labor it is? Or should they be broken out as its own category?
So labor costs are going to be, and when we say labor costs, I'm going to make a leap here and just assume we're talking about the people, right? Most of the time in a SaaS company, the predominant expense in the SaaS business is the people, the benefits, everything related to the people. It's a knowledge worker centric kind of business. So actually, I'll just forward here to the P&L. The labor costs are going to be embedded in these different sections. So, for example, if you look at the cost of delivering a customer in the P&L, the labor cost for support, the labor cost for professional services and customer success is often in this category. Customer success can be split. I meant to mention this earlier. Sometimes we put a portion of that or all of it into the sales and marketing bucket for various reasons, depending on how much of the expansion target your customer success team owns. The labor cost for sales and marketing goes in this line item in operating expenses. Product development, engineers, product designers, product managers go in the product development line, and your HR, your IT, your finance, all your support staff go in G&A. So I hope that answered the question.
Cool. Shannon asks, so top line impact is gross and bottom line impact is after going through the P&L.
So top line impact, you can think of it as gross. Yeah. So gross margin is really, you've got your revenue, right? You get revenue from your customers, and then you've got the cost of delivering to those customers. That is the gross profit. Okay. You're going to basically incur those costs for every customer you sell. If you have 100 customers, you're going to have that much cost. If you have 1,000 customers, you're going to have 77, or in this case, almost 25% of that is going to be cost that goes to delivering them. So the reason that's important is because that's the very first place where you start to get to your profitability, and you can actually adjust profitability. You can optimize it in both of these areas, cost of goods sold and the operating expenses of the business. I hope that makes sense, Shannon. And hi, Shannon. If I think that's the Shannon, I think it is.
Hamal asks, shouldn't customer success expense also be in sales and marketing? You just answered this, so I'll just preface it again that depending on the types of activities that your customer success team is doing, you can look to move those around. So you actually might, I remember a period of time at a company Jay and I worked for, we actually sat down with the finance leaders to go through that, right? An exercise of where are we spending the time? Because then they were looking at, okay, how can we then allocate this on the P&L? So they were asking us, according to these activities, is it to serve the customer? Is it to upsell and cross-sell the customer? And making sure we keep trying to determine those things.
That's right. And really, you need to go talk to your finance team about how they do this in your company. And the reason is because when you change, let me forward one more here. If you were to move costs from the cost of goods sold into sales and marketing, which, by the way, Himmel, that's exactly right. A lot of times customer success costs can go into the customer success or to the sales and marketing line. But if you were to move them midstream or account for them differently in 2024 than you did in 2023, that would actually change your metrics, your unit economics metrics. You have to be really careful with that, right? So usually finance teams, they got it set a certain way and they're going to keep it that way unless there's a really compelling reason to change it. Because if you change those metrics, you have to go explain it to your board, your investors. If somebody's going to buy the company, you have to go unwind and explain why you did it. So a lot of times once it's set, most of the time. I say most of the time. In some organizations, it's cost of goods sold. In some organizations, it's sales and marketing for different reasons.
Awesome. Quick shout out to Stephanie. She just dropped a chat that she bought the course a couple weeks ago. She says, awesome. Know your own pace, all that kind of stuff. Also shout out to Jennifer Tisdale. She just bought the course while we were on this call. So,
nice.
All right. I'm going to mispronounce this name and I apologize, but Vaibhav, in COGS, when you say customer success, does it also include the salary for the CSMs, or is that part in a separate area?
Yes. If the salary is, if you have customer success sitting in cost of goods sold, it does include the salary. It includes the salaries and benefits. All the costs associated with employment sit in these different buckets. That's right.
Awesome. All right. Jay asks, similar to Parker's question with fluctuating headcount, would most people cost fall under COGS or operating expense? You just answered that. Sorry.
Yep.
Tony asks, what is the value in breaking out subscription and usage-based revenue on P&L? ARR and NRR is a little more clear, perhaps because usage-based is less valued versus subscription given its variability.
Yeah, it's a really good question. The value in breaking it out is that typically subscription is governed by a contract, especially if you're doing an annual type of license. So it's a little bit more durable. If it's usage based, it can fluctuate more typically. And when it fluctuates, you just need to be able to call that out to show investors and people who are interested in the company from an ownership perspective, so they understand the different types of revenue. It would be the very same as having, actually at Turnkey, we have customers that buy from us on a monthly basis. There really is no contract. It's just a month-to-month kind of arrangement. And then we have other customers who buy on an annual arrangement. There's different economics involved with that. But it's important for us to know because customers that are on a month-to-month plan are a little bit more volatile in terms of their retention than you might be if you're on an annual plan. So that's why we break it out. That is not a GAAP concept, by the way. It's not like a standards kind of thing, but actually I'll put a plug in for this too while I'm on this topic. There's a group of folks who have gotten together, Ben Murray, Dave Kellogg, Ray Reich, I'm forgetting a few of the names right now, that have started something called the SaaS Metrics Standards Board. And they have a website, you can go check it out. They're actually building on top of the GAAP standards to help us understand what the standards should be in the SaaS world. So that's a really needed and welcome group of people who are working on this right now. And they're helping define what are some of the standards around how you would report this type of revenue versus that. Where do you put customer success expenses? Is it in COGS or sales and marketing, so on and so forth. So I'd encourage you to go check out their website.
Awesome. The next question I've got is from Zafar. which is EBITDA the ultimate way of knowing if the business is profitable or not?
Yes and no. EBITDA tends to be the thing we talk about in SaaS. So one thing we didn't get into in all of this, and you can learn a little bit more about this in the course if you wanted to take it, but there's a lot of, you know, a lot of the things that show up on an income statement aren't necessarily cash. So there's all kinds of different profitability metrics for a SaaS company. There's free cash flow margin, there's EBITDA, there's net income. Net income, if you were, if you're a publicly traded company, that's the ultimate GAAP measure. By the standards, that's the measure of profitability. Okay. But EBITDA, remember, is a way of taking out some of the irregularities that might be due to taxes or interest rates or the way things are accounted for in the P&L. It levels the playing field. Really, the good thing about EBITDA, it shows us it's not the ultimate profitability of the business. That's net income. EBITDA just allows us to more cleanly compare the operations of one business versus the other. So that's probably the best answer.
But I think one way we said earlier too is like the pure operations of that business, right? Like in terms of building that product and getting it to market, selling it, like that is the metric to look at.
Independent of how the business is financed or some of the ways that things are accounted for. Yep.
Let's see. Jay was asking a question back on your LTV to CAC ratio, and he said something along the lines of, is this similar to the rule of 40? I don't know if you want to touch on the rule of 40 real quick, just to give people a sense of what that is.
Yeah, I'll give you just a real quick sense. So the rule of 40 is basically, and we won't get into the technical definition of it right now, but basically the reason that people look at something called the rule of 40, what it is basically a measure of how profitable and how fast the company is growing. And what we want to do, there's a balance there. You can be growing really fast and be unprofitable or lower in profitability, or you could be growing very slowly. But if you are growing slowly as a SaaS company, you better be more profitable. And so the rule of 40 is a way of putting your top line growth metrics, your revenue growth metric, together with your bottom line EBITDA metric, or it's really free cash flow margin metric, to say, are those two things in balance? And when they add up to equal 40, that's when you know you're in the sweet spot, 40 or above. There's more detail about that a lot more detail in the course about it, but what we're trying to do is balance growth and profitability. One more point on that. Over the past 15 years, we've been in the growth at all cost kind of era, right? And that means we could grow really, really fast. We didn't care how much we were burning in terms of how unprofitable the business was. But now that growth rates have slowed for many SaaS companies, you now see the profitability coming out. Go look at Meta's stock chart over the past couple quarters. They skyrocketed at the end of, I think it was at the end of Q4 after their earnings call in January, because they cut so much cost. They kept their growth rate high, cut a bunch of costs. So essentially their rule of 40 went through the roof, and their stock price, they gained like $200 billion in one day. So, that's what we're talking about here, the balance between growth and profitability in the rule of 40.
All right. we're going to end it on this last one. And then we're going to let people, get back into, or get ready for the next meeting, or lunch, whatever's coming after this. But, I really like this question from Jay. He said, what are your tips for identifying your top impact of the 4 for your business? So if you, we flip forward back to your recap slide.
Yep.
So I think what Jay's referencing is, we list that there's 4 ways that impact those unit economics. And so, for leaders that are on this call, how can they identify which one of these they should kind of ladder up maybe some of their projects to, or maybe they should try and impact?
I don't want to try to answer that for everybody, but I gave you a couple of examples on the prior slides of of different things that we're doing that might map to a departmental level. Like if you're trying to increase your revenue per customer or your gross retention, then you're probably going to be working on your renewal program. So that might be something that customer success teams are closely aligned with. If you're trying to optimize your acquisition costs, well, of course, if you're in marketing and leading sales, you're going to be looking for ways to keep your costs low while driving bookings up from those two angles. So it really, part of what this does, which is why I like it, is it blurs the lines between the departments. But if you're in any one of these areas, think about the things that you have control over and think about things you have influence over. And then I would say, connect with your finance team, get to know them, ask them where they think you can make the biggest impact on the metrics of the business. So look for guidance from your team internally on that. But otherwise, we'll share these slides with you as well, and you can sort of dig into them and help try to figure that out.
Yeah, I think similarly to
sorry.
no, it's okay. I think similarly to Jay, like from where you are in the business, what I tended to do was I tried to understand, what is the ultimate outcome of what I was trying to do. I was doing a bunch of customer experience programs when I first joined Higher Logic, and so for me, I was improving some of our, hey, how do we get somebody live quicker? How do I make sure that we're servicing that? How do we help our support team service customers more effectively, right? So as you start to think about some of those projects and measures, maybe on some of the more tactical level that you're thinking about, it starts to, in my mind, start surfacing up, okay, well, if I'm going to help get a customer live quicker, maybe that actually helps us in terms of our revenue recognition and the way that we're able to do that. And then maybe, servicing customers and helping from a support angle, that means we can actually reduce some of our cost of goods sold and how much it costs for us to support a customer. So I think if you start walking through the equation, or like walking through the logic and the steps of like the role that you're in and some of the projects that you're working on, I think it'll start to become a little bit more obvious that way too. We flip back to the opening slide or the earlier slide that we had about the course. There's been a bunch of questions all the way at the beginning. I just wanted to help try and answer some in like one quick shot, which was, so we have 3 sections of the course, which is about 22 lessons. All the lessons and everything are about 5 to 7 minutes. It's really digestible. It's like this, like the style that you get. I'm just not there. Jay's only recording it, but that's the style that you're getting is some of the content you saw on the slides today. I think we've had right now a handful of people who have told us that it took them roughly about 2 hours to 3 hours to go through like all the content in its entirety. You can watch that and go at your own pace. And so, once you have the file, it's easy for you to go do that. I can send this out to people afterwards as well. You'll probably get some emails just about it, but it's something that we're extremely excited for or passionate about, something that's a little different than I think what's out there right now. So I think we're going to land it at that. I did have all the questions listed out, so I've got them in our Notion. We'll go through and answer those, and then we will put it out onto the website, make sure everybody has it. But very appreciative for everyone coming today. This is our first one. We are going to do one in May. So if you want to sign up for that right now, dropping the link in. It's going to be a different topic. So today we focus on unit economics. In May, we're going to focus on annual recurring revenue and try to break that down more specifically. And we're going to look at gross revenue retention and net revenue retention. So think about this style. What we want to try and bring is how would we impact those measures? How do we break them down? What does it actually mean? What is annual recurring revenue, right? Is it the same thing as revenue? Is it the same thing as cash? How do you recognize that revenue over time? Those are the types of things that we're going to try and dive into. So that's going to be May 22nd at 12 p.m. It's a Wednesday. So feel free to come. We'll have another very similar style to this and be putting out the same thing. So with that, Jay, appreciate you doing this and putting all the content together and getting this out for everybody. And appreciate everybody being here. We will see you all again here soon.
Take care, everybody. Bye.